This time is not different. And the reason it's not different is that human nature never changes. So these patterns that I'm going to show you are endemic to human nature, and it's why they work. So what I'm going to talk about today is regression. And all markets will eventually regress to the mean. Smart money, professional traders, they trade with these regressions, whereas the more retail type person or hedge fund, they tend to trade a little bit more emotionally. This was a lesson that took me many years to learn, but and I'm going to show you some examples here. This is the S&P. So when a market gets stretched really far, this is a weekly chart. This is the 200-week moving average. When a market gets stretched really far above the mean, I tend to get very nervous. The average retail trader, the person that's just watching their 401k, many hedge funds, these people tend to be trend followers, whereas a big professional trader, those tend to be regression traders. So they're using different strategies. A smart money trader, they will get more and more nervous as price stretches further and further away from the long-term average. A retail trader, hedge fund, because they're trend followers, they get more and more bullish or bearish depending on which way the market's going, but they become more and more confident that the trend will continue more or less indefinitely, or they think that they're smart enough that they'll be able to spot when the trend change comes, so that they're willing to play musical chairs, so to speak, when we get stretched very far above the mean. So the stock market is a market that I am very nervous in. This is the S&P. You can see we are just stretched insanely far above this 200-week moving average. We are in the timing band for a move down into a 4-year cycle low, and I have no doubt that at some point, and because this is right translating to an extreme degree, then when we do move down into that 4-year cycle low, it's going to look like this. It's going to be a crash event, the same as it was in COVID. Now, the COVID pandemic, it was the trigger to cause this collapse into the 4-year cycle low. I don't know what the trigger is going to be here. Maybe it'll be NATO gets involved in Ukraine, and we start to escalate World War III. Maybe there's another pandemic. I don't know. Maybe the bond market cracks and interest rates start to spike. Multiple potential black swans. But I can say that this is looking for a trigger. Let's put it that way. This is a I wouldn't say it was a bubble yet. I think the bubble phase is going to come later. But this is a market that is looking for the trigger or the pin to pop let's call it a semi-bubble, to pop the semi-bubble and get our move down into the 4-year cycle low. Something that's going to, and all 4-year cycle lows, they almost all of them will come back down and at least get back to the 200-week moving average. Now, I don't think this was the 4-year cycle low because it came too early, in my opinion. So I think this is similar to this. There was some question here as we were kind of going, higher and higher and higher here. It just seemed like the market was bulletproof, and a lot of people were saying that this was the 4-year cycle low, and that was why this was just going to keep going up and up and up. And then, of course, COVID magically appeared just in the perfect timing band for that to happen, and then we get our 4-year cycle low where it belongs in that 4-year timing band. So I tend to think this is the same as this. It looks like it could be a 4-year cycle low, but it's too early. And now we're getting this same bulletproof look in the stock market that we were getting right here and setting the stage, creating the conditions for the crash into the 4-year cycle low. So while people that are trend followers are getting more and more bullish, I'm getting more and more well, I'm not bearish yet, but I'm getting more and more nervous, put it that way. I don't like it when things get stretched this far above the mean, because it means at some point, and I've said this many times in many of my tweets on X or in videos and stuff, one of two things has to happen. Once the momentum fails, you either have to go sideways for a long time to allow the moving averages to catch up to price, or you have to have a big scary correction. I think this is going to unfold as the big scary correction like this, mostly because of the timing of the 4-year cycle. We really, the 4-year cycle low is due right now, any time right now, probably going to come in the beginning of fall. And there's just not enough time for the market to churn sideways for a year or 2 years and allow this to catch up. So I suspect this is going to be a crash event similar to this. Now let me look at a couple other markets that also have me nervous. All right, this is the semiconductor index, and this is this is what is driving this. It's the AI mania. I don't think we've reached the like the 2000 level. Where tech stocks were just trading at insane levels, and most of the companies didn't even have any earnings. I don't think we're at that stage, so I'm going to call this a mini bubble, not a real final bubble. But I think it's about time for the mini bubble to collapse. And there's been nothing more representative of a mini bubble than the semiconductor index. Now that doesn't mean I'm calling a top here, even though we got kind of a key reversal. We could definitely continue higher for a few more weeks, maybe another month or so. But I do think we're probably going to get our 4-year cycle low this year. So I'm going to say there's limited weeks left. And this kind of a insane stretch above this long-term moving average has me very nervous. So, you need to have a trailing stop on any of your stock market positions here. All right, this is the NASDAQ Composite. And we've got a breakout above 16,000. We tried to get above it here. Obviously stretched way too far. Everybody bullish. And then we get a move back down to and actually below the 200-week moving average. So the smart money traders, the regression to the mean traders were right. And the trend followers, the emotional traders, again, wrong at the major turn. We're in a similar situation. We've broken out above 1600. We sliced through 1700 like a hot knife through butter, and we've tested 1800. I've called in the past that we could, definitely see 20,000 or even higher during this bull market. I don't know that we're going to see 20,000 during this move before we start that move down into the 4-year cycle low. So it's entirely possible that maybe we get a test of. And we were, pretty close, about 50 or 60 points away. Maybe that is our top. It's a pretty nice move above this peak, and maybe that's where we get our top, and we have to come back down and get that 4-year cycle low and reset sentiment, and then we go back up again, and then we hit 20,000 or 30,000 or wherever this eventually goes. I tend to think we've got quite a few more years, because this bull market's only 14 years old, and the last couple of them were 20 years plus. So again, I think this is a mini bubble, not a real final bubble. But this has me very nervous. Too much white space between price and the 200-week moving average, and right in the middle of a timing band for a move down into a 4-year cycle low. So very nervous here. All right, metals, kind of the same picture. We just got ahead of gold, got ahead of itself. We had this breakout rally. Everybody saw that. Everybody's piling in, and you're seeing targets of $50 in silver. I'll show you the silver chart next, but $50 silver, $3,000 gold, and absolutely yes, but not yet. We have stretched price too far above this long-term mean, and the momentum has cracked. And once the momentum cracks, then one of two things have to happen. And you can see we're stretched about as far above the mean here as we were here. Now, one of two things. Either you got to go sideways a long time to allow the moving average time to catch up, or you got to have a scary correction. And you can see that's exactly what happened here. Gold for about 3 years was moving sideways, and then we kind of had the final scary correction down into that 8-year cycle low. We start a new 8-year cycle. Obviously, during this 8-year cycle, this is where the breakout above this is going to come. We get the breakout, but that generates massive bullish sentiment, and you start to get these insane targets. And again, I think those targets are going to be met, but we don't want them met right now. For gold to go straight to 3,000, it would almost be a bubble, and we need the wall of worry phase to last much longer. The longer the wall of worry phase can last, and I'll extend this chart and show you, then the higher the final bubble phase will be. You don't want to break out of this and then immediately go into a bubble phase, because at that point, you're probably the maximum you're going to get out of the whole secular bull market is 3,000 or 4,000. If we can stay in the wall of worry phase for 3 or 4 years, then our target becomes 10,000 or above. So now let me back this chart up and show you what I'm talking about. All right, so here's our last major bull market in gold. It started kind of with a double bottom in 2001, and then we climbed the wall of worry. Lots of correction, never really got stretched terribly far above the long-term mean. And then when we did, we would get these moves down into the 8-year cycle low, have to consolidate, get another leg up, another big move down in, this was actually the 8-year cycle low here. And then we kind of started that almost parabolic move that takes us to this top. Now let me convert this over to a daily chart, because it's a little bit more clear in the daily chart. All right, so this is kind of that final run. Once we get the breakout above $1,000, then we get that move up to whatever it was, 1920 or 1930, something like that. But you can see we were climbing the wall of worry. We get these rallies, they get a little bit stretched too far, and then you get a regression event, profit-taking event, come back down to tag, another rally, another attempt to break out, and another correction. And then we break out, and then we get that same kind of mentality that we've got now. We've waited and waited and waited for this breakout above 1,000, and now we got it. And now everybody sees it, and everybody's piling in. And I distinctly remember this. We were looking at $2,000 gold already at this top. The retail traders, hedge funds, the trend followers were assuming that this trend would never end, and we were just going to go straight up. But that's of course not what happened, and that's not what you want to happen. You want to climb the wall of worry. You want to keep that wall of worry going as long as possible before you get into that final manic bubble kind of bubble phase, parabolic phase that is the top. And so what happens, we had to come back down, and we had to test that breakout right here. We had to test the breakout, and I still think we're probably going to test that breakout at 2100. And then another rally, and then we kind of break out a little bit, but not huge. We don't go parabolic or anything. And then we get another correction, and then another breakout above this peak, and then what almost looks like a final bull market top, kind of a triple top thing here, and then another correction, but this was not the final top. And then again another breakout, another sideways. This was more one of those sideways things to allow the moving average some time to catch up, rather than a steep correction. And then we get the vertical move that gives us that final bull market top. So we spent a couple of years in this wall of worry phase before we get that final blow off move, and that's what we need to happen now. We've got the breakout. We need to spend as many years as possible in the wall of worry phase, where we have to come back down and retest the long-term mean, which in this case is the 200-day moving average, or if we don't do that, we need to go sideways and allow the moving average to catch up. So you don't really, we don't want this. We don't want silver going to $50 right now. It's too early. Let me put the silver chart on here. All right, so you can see what's happening here. We've broken out above this resistance zone here at about, let's call it $30, a little above $30. And everybody was assuming that silver was going to do the same thing as gold, that it would just, once the breakout occurred, we were going to run to $40 or $50. But that's not what happened, because we broke out late in the cycle. So the breakout is failing to hold. We're trying to recover, but each attempt to recover fails. And so we're just not holding this breakout like we did with gold, and it's because the breakout came too late in the intermediate cycle. And we're stretched too far above the mean again. And so silver needs to do the same thing as gold. It either needs to trade sideways and allow this some time to catch up, or it needs to correct, maybe back down to this $26, which was resistance and would now be support. That would be enough of a correction, in my opinion. I don't think we have to come all the way back down here, but we got to shrink some of this gap before we're ready to come up. And if you look at this, you can see how unrealistic it would be for silver to get to $50. Probably not by this year. I don't think $40 is unreasonable by the end of the year, but I think $50 is probably it's just too far. You could see, if we're up here at $50 by, let me put the cursor on December. I'm in the December time frame right here, and you could see the 200-week moving average is going to be down here at 25. So we'd be 100% above the 200-week moving average, and that's just too stretched. The chart at this point would start to look like this chart right here, and you can see what happened here. We just got a total and complete collapse in silver. And the same thing would happen. We're not going to be able to maintain a move that far above the long-term mean this early in a bull market. This needs to be more gradual. It needs to climb the wall of worry. So what I think is entirely possible is if we were to come back down and retest this $26 support and then rally from there, I think a move to $40 by the end of the year is possible. And then we would have to, again, we'd have to have the same thing. We'd need some kind of a correction or a long turn sideways. And then eventually, when we get to the end of the parabolic top of the market, then we'll see this same kind of move in silver, but it'll probably be a move from maybe from $50 to $250, or from $100 to $500 will be this final parabolic move that just goes crazy to the upside. But it's just too early right now, and we don't want this. We don't want this kind of behavior to begin right now. We want to stay in the wall of worry for as many years as possible, and that will produce the highest move at the final bull market top. The longer we can stay in the wall of worry, the further we go in this secular bull market. The quicker we transition to the parabolic phase, the lower the final bull market top will be. So these are markets that are just I'm nervous. I'm very nervous in the stock market. I'm nervous enough in the metals that I just don't think we're ready for another move higher. Like all of these people are trying to convince you that silver's going to silver. No, it's not. Not going to silver, not yet. Not unless we're starting the final parabolic phase. And if that's the case, then silver, $50 silver is the top. That's as far as you're ever going to get. And that's not what we want. We want $500 silver. But to get there, we're going to have to be in the wall of worry for 2 or 3 more years. And then one market that I do like is energy. So we had the move, stretching price way too far, And then in energy's case, this was a sharp collapse back down to the moving average, not so much a sideways churn. And now we're in the sideways churn. Now we're building the base, and we are not stretched far above the mean, and I don't think there's any chance of us getting stretched very far below the mean. And so this is a market that I am constructive in. I think this market has potential, and I'm not terribly nervous about the energy market as I am in stocks and metals. The momentum has clearly cracked in metals, and I'm very worried about what's going to happen when the momentum cracks in the stock market. There is no big momentum in oil just yet, but I think we could develop some in the next several months. But this is a market that I'm constructive on, and I'm sure there are other ones as well. But for the markets that I like to analyze, this is where I'm constructive right now, is in energy. And I'll give metals time to consolidate, and I'm way too nervous to just trailing stop in the stock market. I don't want to get caught when the stock market crashes. So this is how regression works. It works because human nature never changes. We get optimistic, then we get overly optimistic, then we get ridiculously stupid optimistic. That creates these huge stretches to the upside, and then we have profit-taking event corrections. And then, as that progresses, we become pessimistic, and then eventually we get to stupid pessimistic, and then you're set up for the next rally. So human nature, it's what drives these moves. Smart money plays these regression events. They get nervous when price stretches too far from the mean. People that don't really understand human nature and how markets work, they get more and more confident as these trends get stretched further and further away from the mean, and that's why most people or a lot of people lose money in markets. They get too confident when markets are stretched too far to the upside, or they get too pessimistic when they're stretched too far to the downside when they should be doing the opposite. So it's like, I think Warren Buffett said, when everybody wants something, that's when you need to sell it to them. When nobody wants, or when everybody wants to sell you something, that's when you should take it from them. Pretty much everybody's wanting to sell oil right here, so I think I want to take it. Everybody wants to buy stocks and to some extent metals, so I think I want to give it to them. And I want to do the opposite of what the vast majority of people are doing. I want to play something that nobody really wants it, and I want to let others play things that everybody is piling into and is assuming will never turn and go in the other direction.